Okay, I think we are about there. So we will start. And good morning. Thank you all for joining us today for our webinar on Jeremy Hunt's Spring Budget 2023 statement. I'm Chloe Ellis, our Head of Privately Owned Business Tax at Mazars, and I'm going to be the host for today's webinar. However, I am delighted to say that I am joined by a number of colleagues. So I think everybody's got their cameras on, and if not, could put them on. We've got George, who is our Chief Economist, Nick, who's one of our private client partners, Pooja, who is one of our privately owned business tax directors, and Ian Goodwin, who is our one of our employment tax partners. So a bit of housekeeping, if I may, before we start in earnest. For those joining us on Zoom, we've got the Q&A box at the bottom, so please do put any questions in that, and we should have some time at the end to answer those questions. And for those on LinkedIn, please just use the comment section for any questions. We are recording this session, and the recordings will be made available afterwards on our website, and for those joining on Zoom, we will send an email. My final point on housekeeping is that me and Ian are sat in one of our offices that we have been told is going to have a fire alarm practice at 10:30. We don't think we'll have to leave the building, and hopefully neither of us will be talking at that time. So I'm just putting it out there, but hopefully that won't affect any of us. So let's get straight on to the spring announcements then. Jeremy Hunt unveiled this, what he called a budget for growth, with a number of key headlines really, ranging from increased funding for childcare, keeping the energy price cap, and a pensions and benefits overhaul. You probably all heard as well that he gave a number of reassurances around falling inflation and economic stability, with the prediction inflation will fall to about 2.9% by the end of the year, although I know George is going to have some comments on that. So over the next 45 minutes, we'll hear some more about some of those announcements, but let's go straight into you, George, if that's okay, on an economic perspective and what all of the announcements might mean for the economy.
Thank you very much, Chloe. Hi, everyone. My name is George Lagarius. I'm Chief Economist at Mazars Wealth Management. So you're in luck because I won't talk much, which is rare for me. Overall, the budget had a tilt towards growth. I think the UK government understands that UK growth is lagging versus other peers, and it rightly focused on repairing that. So the better news from defense spending, some tax giveaways for specifically targeting various groups, especially some key employees like NHS employees that the country direly needs. And I think it's more interesting to me, although it might not have gotten the publicity it deserved, also some initiatives towards regional growth, i.e. growth outside of just London and the finance sector. And I think that's very important because in a post-Brexit world, balanced growth and non-financial sector growth could be key towards a prosperous Britain. Now, this is the good news. The news that has slightly, let's just say, made us more thoughtful. And let me share my screen. Share. I hope you will all be able to see the presentation. is that overall the government, well, the OBR's projections are a little bit on the optimistic side. So the UK is projected to, output is projected to drop by 0.2% at year on year at the end of this year. The IMF is projecting triple that, although we're talking about small percentages, it's easy to say double, triple, all that. But it's projecting a 0.6. The EU Commission is projecting a 0.9, and the Bank of England is projecting a 0.5. So the OBR is definitely on the optimistic side. More importantly, and because you can have your growth, but you cannot have your growth easily and lower inflation, and that's when things begin to get tricky. So the OBR is projecting nearly 3% inflation at the end of the year. The IMF projects something around 9%. I think that's too pessimistic. Our view is something between 5 and 6% would be what you should expect inflation to look like at the end of the year. And generally speaking, versus the rest of the market, we're also on the optimistic side. So if you get a more generous budget towards growth, you'll get a little bit more inflation, not that much less. All other things being equal, of course. Now, the larger theme here is, however, that the OBR is taking an optimistic stance. And this is a world with a lot of potential outcomes. In the beginning of the year, our theme was, this is the age of disruption, not the tech disruption where we just introduce ChatGPT and say that's disruption. We're talking about systemic wide disruption. And if anything, anybody following the news lately with the US banks, or a month ago with the issue with Adani, remembers that. So this is the time when we have a lot of liquidity drained from the system, and that tends to lead to things becoming issues that were not issues before. So we're going to see a lot of that this year. That was the theme for our quarterly at the beginning of the year. We're going to see a lot more volatility and a lot more twists and turns. So the OBR could end up being right and the rest of us wrong, or the OBR could end up being completely on the wrong side and the economics could be much worse. Honestly, it's very difficult to say. Every year since the pandemic has less and less and less visibility. So the key, if you're a business, if you're a private client, the key is flexibility, is revision, is not sticking to one view until the end of the year, but it's adapting and adjusting your view as things change. To use the central bank language, it is to be a little bit data dependent. So in both our general economic and UK economic quarterly, which just came out, that view is pretty much represented. And with that, I'll pass it back to Chloe.
That's brilliant, George. Thank you. And it feels like a real balanced overview there, with the kind of message being around some volatility and uncertainty, but that doesn't necessarily mean a pessimistic view. But let's move on then, Nick. And there was a lot mentioned in the statement around what may affect individuals, some immediate and some longer term changes. So maybe you could talk through some of that with us.
Sure, thank you, Chloe, and morning all. Yes, in some ways, nice to have a budget that gives us a lot to talk about. So unlike George, you probably will hear quite a lot from me over the next 10 minutes or so. So just a quick introduction. I'm Nick Nesbitt. I'm a private client partner and a financial planner. I'm based in our Manchester office. And from a private client perspective, this back to work or budget for growth, that it's been termed, was very pensions heavy. We were sort of in an age of relative stability from a pension legislation perspective, but that's thoroughly gone out of the window now, and we've now got a whole new set of rules to think about. So I'll spend most of the time today focusing on pensions and then just recap a little bit on some other very minor changes that we saw in the budget and some other updates that private clients just need to be aware of as we go into the next tax year over the next month or so. So starting with pensions, it's probably worth going what now feels like a long way back to Wednesday morning and reminding ourselves of what pension legislation we woke up with on Wednesday morning. So at that stage, most people could put £40,000 a year gross into their pensions. Those with higher earnings, broadly over £200,000, had their pension contribution tapered down to a minimum of £4,000 a year. There was a lifetime limit called the lifetime allowance, which kept people from having more than, well, you could go over the million, but it was punitively taxed. So there was a lifetime allowance of 1.073 million. And then there were also these restrictions called the money purchase annual allowance, which stopped people really from resaving notably after they'd accessed their pension benefits. And that felt like a relatively sound set of pension legislation. There were certainly people that were caught by it, and as I'll come on to talk about later, the medical profession was definitely negatively affected. But clearly, I felt a need for change. So in terms of what actually happened on Wednesday lunchtime, there was an increase of 50% in the annual allowance. So people will now be able to contribute up to £60,000 a year to pensions. They kept the tapering of the annual allowance for those people that earn over £200,000, which for me feels like a bit of a missed opportunity to simplify the whole system and stop sort of strange thresholds where there's disincentives to earn any more money. But alas, it seems to be staying, so we'll have to continue to plan around that. The big shock, and it really was a shock. I was on a webinar with some colleagues, and we were all sort of a bit flabbergasted, to be honest with you, by the complete abolition of the lifetime allowance. There were plenty of rumours that it might increase by 10% or maybe even go all the way back up to its highest ever level of 1.8 million. But nobody I saw predicted the complete abolition of the lifetime allowance. So that was probably the most notable change on Wednesday. And then there are a couple of smaller points. They did increase that money purchase annual allowance, so the amount that you can contribute again once you've accessed the pension. And there was an introduction of a capping on the amount of tax-free cash that people can take. And they've essentially capped that at a quarter of the outgoing lifetime allowance. So people won't be able to access more than £268,000 of tax-free cash. So just a quick reflection, because it would be reasonable to sort of think, surely this is a budget that only really impacts on those very wealthy individuals that have the ability to contribute over 40,000 a year or have pensions in excess of £1 million. And of course, to an extent, that's a fair comment. However, it's important to be aware of the medical space and the fact that obviously the NHS is under pressure from many angles at the moment. But one of those angles is that many senior doctors are leaving the profession or reducing their commitments because of the way the NHS pension works. Is they're up against both of those annual allowance and lifetime allowance limits. So I think, in my opinion, I think that's probably where a lot of this legislation change has come from. If we now sort of move forward to what planning opportunities and discussions it's already creating with our clients, I mean, it's widespread. I think most people need to dust down those pension folders and have a think about where they're at in terms of their pension planning and what changes these legislation changes will permit. I think ultimately it will see a huge amount more money flowing into pensions, which seems a big change of direction. Over the last 5 to 10 years, the government's been seemingly much more in favour of ISAs than it has of pensions, and there's been lots of talk about reducing the ability to get money into pensions. This clearly sort of suggests a change in direction on that front. So there's going to be lots of people, as I say, rethinking how much they put into pension. Even those people who perhaps have retired and have already used all of their lifetime allowance, there's going to potentially be scope for you to start putting more money into pensions. And I think that we've always talked about the potential inheritance tax benefits of pensions, but that's just going to become more and more of a focus. If this legislation remains in force for the long term, I think you'll see people building up much larger pension funds than they have done over the last sort of 10 or 15 years since the lifetime allowance was introduced. I mean, I was just on that note, I was doing some sort of calculations, and it's a bit of a niche example, but I was sort of looking at if you were a business owner and you worked in your own business for 50 years and you had the potential to put in £60,000 a year for those 50 years, and you happen to achieve 5% growth, you'd end up with a £13 million pension fund. And obviously, there's some assumptions there, not least that legislation might remain unchanged for 50 years, which is highly improbable. But it just shows you the difference in planning opportunities that this legislation might create. However, with all these things must come a note of caution. And there's two things I'd say here. One, and this is probably a reaction to tens of calls from clients over the last 36 hours. The legislation is not yet in place. I think that's really important to understand. The legislation is not yet in place. It's planned legislation change, and try and avoid the political commentary, but we are not, we're quite used to some political U-turns over the last year or so. And already there's been some suggestions that other governments wouldn't support this sort of change. So I wouldn't jump feet first into planning before the 5th of April without very careful consideration of the risk of a U-turn or the risk of future reversals of such changes. So by all means, dust down those folders, have a think about what it might mean to you, talk to your tax advisor and financial planner about what it might mean, but just be cautious about any sort of very quick planning decisions. So now just to turn away from pensions and quickly recap on mention a couple of other changes. And there really were only a couple of other changes mentioned in the budget from a private client perspective, both pretty niche, really. One was some changes to the rules that sit around agricultural property relief and woodlands relief. And the other was a positive change or confirmation of a change in relation to the administrative burden of trusts for trustees. So that was a positive change, but again, relatively niche. Otherwise, there was no changes really from a IHT perspective, no changes to non-dom status, which is something that we thought we might see. And really the main other things just to finish on are the changes to personal taxation, which we were already aware of. There were no changes mentioned in the budget to those. So, and most of them, if not all of them, are unfortunately not positive. So capital gains tax exemption, which is the amount of gains you can receive or realise tax-free each year, will, from the 6th of April, be just over halving to £6,000 a year from the current £12,300, and then is planned to halve again to £3,000 in April 2024. So something to be aware of, and probably the call to action there is, if you have the ability to do so, try and realise some gains within your exemption before the end of this tax year. Similarly, the dividend allowance, which is the amount of dividends an individual can receive tax-free each year, will halve from £2,000 to £1,000 next month, and then from £1,000 down to £500 in April 2024. And lastly, really, the additional rate of tax, so the point at which you start to pay 45% tax, is going to come down from its current £150,000 level to £125,140. And that is essentially the point at which you come out of that nasty personal allowance trap where you pay 60% tax, and then you'll move straight into 45% tax. Just to finish on one for our colleagues and friends north of the border, they will see their higher income tax rate, so the higher and additional rates of income tax, go up by a further 1% on each of those bands from the 6th of April. So the higher rate of tax tax in Scotland next year will be 42%, and that additional rate in Scotland will be 47% compared to 40 and 45 south of the border. So I think that's a quick flyby of the private client implications, Chloe.
That's brilliant. Thank you, Nick. And I think we're taking from that lots of changes on the pension side of things, but watch this space as to actually that pans out as Jeremy suggested, with everything else really being in line with expectations around personal allowances, tax rates, etc. Brilliant. Thank you. So Pooja, maybe we could move on to the corporation tax side of things, which in some ways I don't think was as exciting as the changes announced, say, on the pension side, but there were a couple of key changes announced, weren't there? So maybe you could talk through those for a minute, please.
Yeah, that's right, Chloe, and good morning, everyone. So while there haven't been groundbreaking changes to corporate tax, there are a couple of things our listeners today should be aware of. So to start with, the super deduction, which is the 130% capital allowance rate, has worked well in that it's encouraged planned investments to be brought forward by companies, and it supported the post-pandemic recovery. But this is coming to a close on the 31st of March. And so as not to lose momentum, it's being replaced by full expensing from the 1st of April through to 31st of March 26. The tax benefit of full expensing is in fact greater than the super deduction, even though it's at 100% instead of 130%, because it's being applied to a 25% rate of tax. But the intention is that this could be a permanent change to the capital allowance regime, but I don't think this is clear cut, and it's likely to depend on political and economic stability in the long term. So what is full expensing? It's an uncapped 100% fair share allowance for qualifying spend incurred by companies that are subject to corporate tax. So it's not going to be relevant to unincorporated businesses, for example, that don't pay corporate tax. The examples of items that can benefit from this relief include, most tangible assets used in the ordinary course of business, so things such as machinery, office equipment, warehousing or construction equipment, certain vehicles. But I guess now businesses that spend less than £1 million on CapEx a year are not going to be impacted by these rules and these changes, because they can make use of the annual investment allowance, which is now being made permanent for expenditure up to £1 million per year. But profitable, capital intensive businesses can take advantage and benefit from the relief being uncapped. And for them, for example, £25,000 could be shaved off a corporate tax bill for every £100,000 of eligible expenditure. I guess while this is still a timing difference for tax purposes, the immediate cash flow advantage should help during the cost of living squeeze that we're in. A similar 50% fair share allowance will continue to be available for qualifying spend on special rate assets. So these are items such as electrical systems, heating systems, lighting systems that you typically see integral to buildings. But as mentioned earlier, this is obviously going to impact businesses that spend more than £1 million a year on CapEx. I guess the final point to be mindful of on the capital allowance changes is the impact this has on deferred tax and balance sheets. So the acceleration of capital allowances in recent years is creating deferred tax liabilities on balance sheets because of the assets are depreciated at a slower pace through statutory accounts. These new announcements, which could be here for the long term potentially, are likely to increase the size of these deferred tax liabilities on balance sheets as more CapEx is incurred. So that's something to be mindful of by the companies that are impacted by this.
That's brilliant, Pooja. And yeah, the government's announcement was very much about encouraging that capital spend on Wednesday, wasn't it? Yeah. I think the main area on the side affecting companies and corporation tax was around research and development tax claims and the announcements around that. Could you talk us through that for a bit, please?
Yeah, of course. So just to recap the changes that were previously announced that are going to take place from 1st of April. So the RDEC scheme for R&D for large companies is becoming more generous, and it's increasing from 13 to 20% for qualifying spend. But the SME R&D schemes are heading in the opposite direction, with the enhanced deduction reducing from 130 to 86%, and the SME tax credit reducing from 14.5% to 10%. And, this has primarily been driven by the government's concern that the SME scheme has been abused historically. And, now they want it to be addressed, and they're putting a lot of resource into this space. What we've seen at Mazars, we've seen both a delay in repayments being issued to businesses and certainly more scrutiny of R&D claims in recent months. So it's probably worth speaking to a professional advisor who can analyse and review the eligibility of this expenditure upfront, particularly as now there's more admin around making R&D claims and what's submitted to HMRC. And there's a lot more disclosure as to who's supporting you in preparing an R&D claim. But I guess in terms of new announcements, and I guess this is not to penalise loss-making SMEs that are heavily involved in R&D, the SME tax credit will remain at 14.5% for them. And I guess the definition for a SME that's heavily involved in R&D is one that's total expenditure is, sorry, more than 40% of its total expenditure is on qualifying R&D activity. And this is likely to be particularly welcomed by startup companies that are prevalent, for example, in the tech sector or life sciences sectors, particularly since the government is extending the scope of qualifying spend to include the cost of data sets and cloud computing from the 1st of April. And it's estimated that around 20,000 businesses are to benefit from this targeted relief. The second announcement made on R&D was the delay of restrictions with regards to overseas R&D expenditure, and that will now take effect from the 1st of April 24 instead of the 1st of April 23. And this is in the context of ongoing consideration by the government of a potential new R&D tax relief scheme that's going to merge the current SME and the RDEC schemes together. The design of this new merged scheme is under consultation at this stage, and certainly our specialist Mazars R&D team have shared their views as part of the process, and they welcome a simplified regime. The consultation only closed a few days ago, so no decision has been made as of yet. But we understand the government's keeping an open mind about the potential of a merged scheme from April 2024. So let's watch this space.
Brilliant, thank you for that, Pooja. And you briefly touched on some of the admin changes and notifications. Could you talk us through what the prior notification requirements relate to and how they may affect some of our listeners today?
Yeah, I mean, that's a really good point, Chloe, because a prior notification requirement, it's a form which includes certain details, and it's submitted to HMRC by companies that are new to making an R&D claim, or a company that hasn't made an R&D claim in the last 3 years. And it's only just been introduced, so it applies to accounting periods beginning on or after 1st of April 23. And the notification must be made within 6 months of the end of the relevant accounting period. There's been speculation as to how it will work practically, and HMRC has since released some guidance, but what's causing a little bit of concern is there's a cliff edge deadline in that if a notification isn't made on time, any R&D claim made for that period won't be valid. And there could be businesses carrying out genuine R&D that could benefit from this relief that potentially miss out. So the key point to really take away here is if you're incurring R&D costs and you haven't made a claim in recent years, particularly in the last 3 years, speak to your usual tax contact sooner rather than later.
Brilliant, thank you, Pooja. So I'm taking from that we can't just wait till we're doing our final tax returns to start thinking about R&D, because we could miss a claim, the ability to make a claim based on that. Brilliant, thank you. Before we hand over to Ian to talk about employment taxes, is there anything else that you wanted to mention on the corporation tax side of things?
I think very quickly, it's probably worth mentioning a couple of points around the rate change and the impact it's going to have. So we know it's going ahead, and the main rate will rise to 25% from 1st of April. This will be applied to companies with profits in excess of £250,000. A marginal rate will apply for companies with profits between 50,000 and 250,000, And for companies with profits below 50,000, they'll continue to pay tax at 19%. So that all sort of seems straightforward. But I guess what's important here is the potential division of these limits and division of these thresholds. So I guess while the CT rate changes has sort of been mainstream in headline news, what's been less publicised is a change around associated companies, which is also taking effect from the 1st of April. And what this means is, instead of dividing those profitability thresholds by the number of 51% subsidiaries in a corporate group, the limits will instead be divided by all companies controlled by the same individual, even if they're not in the same corporate group. And, we think this may impact some of our entrepreneurial clients, particularly in the privately owned business space, where they may have expected some of their companies to continue to pay tax at a lower rate, which now might be pushed up to this 25% rate of tax. And then the other impact is, of course, that these companies would also shift up into the quarterly instalment payment regime for tax purposes. So that's one to watch out for. And I guess another point that I thought is worth mentioning is there's been simplification around the admin in respect of EMI schemes. And one of the key changes which we welcome is the notification requirement of EMI options that have been granted, where before, if they weren't done on time, they'd lose their tax advantage status. And it's something that causes problems at DD stage, and it's obviously costly for everybody involved. But now the Revenue have simplified this. So instead of having a sort of a time limit after an option's been granted, it can sort of sync in with ERS compliance procedures. So, HMRC can be notified on the 6th of July after the end of a tax year, along with other share movement notifications they receive in ERS compliance. That was it from me.
That's brilliant. Thank you, Pooja. So we seem to be going two ways. R&D might have to be notified earlier, and hopefully EMI, we might have a longer period to make notifications.
Yeah.
So I think finally, but not least, is Ian now. So one of our employment tax specialists and tax partners within Mazars. So Ian, if we could just have a couple of minutes from you, and maybe you could start on actually talking about some of the announcements relating to childcare, because I've seen an awful lot over the past 36 hours on discussion on that.
Thank you, Chloe, and hi everyone. And it's nice to be last for once, Chloe. I think IR35 and CGRS have been the key headlines over the last few years, so it's nice to be at the end of the childcare piece. There's so many different childcare support mechanisms. What was announced this week was one that relates to individuals to claim free childcare. Now, there's free childcare in place for 3 to 4 year olds already in the UK. What they are doing is they're extending that to 9 months upwards. So it's covered up to when they're 5, really. However, that's not coming in straight away. It's coming in, it's going to be staggered between April 24 to September 25 for parents who've got children of that age, and there's still going to be the same limits and conditions applied as there is for 3 to 4 year olds. This is not an arrangement that employers get involved in. It's very much something that individuals will sort out themselves. There is support that employers can offer. There's the childcare voucher scheme that still exists, even though it closed to new entrants in October 2018. So anyone who participated in that through their workplace can continue to if they participated in it prior to the date it was closed. There's also the separate arrangement that the tax-free childcare that people can get tax relief on at basic rate up to certain limits. I think it's £2,000 tax relief you can get through an account for other childcare provision as well. So you can either be in the employer childcare voucher scheme or that tax-free childcare scheme, and then this free childcare scheme is separate to that. So there's some elements of support. The other conversation I've been having in this area is around nursery provision. An employer can provide nursery provision tax and NI free to their employees. However, there is some very strict conditions around that. And we are getting more questions asked here because more people are trying to get people back into the workplace. And obviously that's what the government were focusing on here. They wanted people to get back into the workplace with all these announcements. With the nursery provision aspect, you need to be able to demonstrate as an employer that you are centrally managing and financing that nursery. So where you are potentially buddying up with nursery providers in the local area, that potentially might not qualify for the exemption here. It's just one thing to note, because I am seeing a lot more conversations about this as people are looking at ways they can manage costs for their employees, but also as an employer as well. I think that's probably it from a childcare perspective. To say this, the announcement is, I think people thought it was going to be instant, but it's going to take a while to get this free childcare up and running. So at the moment, it's something that, you know, we're likely to see a few more updates on, see whether there's any changes in the rules, and also it's something just to continue to watch out for, I would say, as more news comes out about it through media pressures and also other discussions within Parliament.
Brilliant, thank you, Ian. And I think another support measure that was mentioned was around the energy support for individuals, wasn't it?
Yeah, it was. I think here what we've seen is, again, this isn't something the employer goes through the employer, it's for individuals directly. They're trying to keep energy bills lower for people, and what they're trying to do is keep that average of £2,500. So they're extending it for a further 3 months, I think up until the end of June, with the £160 support for those 3 months. So it's going to be something that individuals will benefit from. I think that's been received mainly on a positive basis. The key thing for the government here is to manage inflation. That's what they're really looking at, so they can bring energy costs down, and people's energy bills will then hopefully be less over the summer months. I mean, hopefully it's not a cold summer as well from that perspective. So that's one of the big hopes here. Otherwise, we may see more pressure on that as we get to the summer and beyond too, if inflation continues to be high. And obviously, you know, George is probably best placed to comment on that, as he has done so already. I think there's some things employers can do to help here. And again, it fits into what you're doing with your employees and workforce generally. If people are working in a hybrid basis, so they're doing a few days at home, it may be that you may think, actually, we could pay them the home working allowance. Now, the home working allowance is £6 per week or £26 a month, and it can be paid tax and NI free. Even if people are just voluntarily working at home during their normal hours for a couple of days a week, it doesn't have to be a robust working at home permanently arrangement to pay that to your employees. So that's something that could be done tax and NI free. We are also seeing some organisations look at this in a little bit more detail. So they're thinking, well, can we provide a green energy loan to our employees up to, say, £10,000, so under the beneficial loan threshold, to help them afford things like heat energy pumps and solar panels and things like that, to look at their energy at home. And also from the other side of the fence, where people are coming back to the office and not working at home as much, it's a case of, well, how can we help them with their costs of travel? So is there season ticket loans we can now give again for public transport? Or can we look at our vehicle and fleet policies and think, well, actually, let's move to a hybrid electric model where that's appropriate too? And can we offer other benefits potentially as well, like electric bicycles and different types of arrangements if you're looking at, encouraging people back into the office, car parking for people who might be sharing and things like that, provided they fit with those ESG and sustainable credentials. It's important to make sure they all marry up together.
Brilliant. Thanks, Ian. I don't know if anyone else can hear that fire alarm. It's rather distracting at this end. Anyway, there were a couple of other announcements that maybe are relevant to our listeners today in things that are coming in maybe further down the line. Could you just touch on those, Ian, please? Yeah,
sure. I think one of the other key phrases from the budget the other day was returnerships. There's been a lot of pressure on apprenticeship levy and people want it abolished. Jeremy Hunt didn't mention anything about the apprenticeship levy on Wednesday at all. It's left as it was, and I think we've seen from the British Retail Consortium and hospitality groups, they're pretty frustrated with that, if I'm honest. But what was announced was a kind of commitment, even though we've got to work through the details, to encourage over 50s back into work through what's called a returnership. So it would be like a skilled apprenticeship in that way. And they are putting £63 million worth of funding into that. Now, there wasn't much detail within the Red Book on that at all. So we are waiting for the detail to be published, and we are waiting for when those things will actually go live as well. They are looking at hosting 8,000 skilled boot camps, they've said, as part of this. And we don't know quite how it's going to interact with the apprenticeship levy and whether you can use the levy funding or the funding for this, to help retrain or to encourage people back to the workforce. That's, again, the ultimate aim, a bit like what Nick said with in the NHS. The government are looking to get people who are able to work back to work and encouraging them to do that, particularly after a number of people stopped working following COVID, and obviously with all the economic pressures on things at the moment too. So that was one of the other key announcements, I would say. And I think connected to that as well was the announcement around 12 investment zones. We had the announcement previously about Freeport zones. It's similar to that in how that will work, and there will be a number agreed across the country. West Yorkshire, where me and Chloe are at the moment, was one of those, but there are a number of other ones too. And that will tie in because they're trying to encourage certain parts of the country to encourage more employers to be there, and also to then encourage more people to be employed in that area. And that will link in with apprenticeship reliefs and national insurance reliefs and other reliefs as well. So that's something to watch out for in the apprenticeship space and the encouraging people to get back to work space as well. The last thing I probably wanted to mention was around global mobility and immigration. It is noted that the government are now going to commit to looking at the shortage of occupation list in a more regular and frequent manner. They are looking at adding more of the occupations that are seen as in short supply around the construction sector and the hospitality sector. And that probably comes off the back of the fact that the hospitality and retail consortium were pretty frustrated with they weren't able to make any changes to the apprenticeship levy. So they are looking at how they can encourage more people to free the labour market for that area of that sector in the UK. So that's important to note too. And separately, they are looking at the permitted and paid engagements for up to 6 months, so people who are looking for certain visas can come in more easily. So there's less restrictions on them in that sense. And our immigration team, are publishing content on that and looking at how they can help organisations that might be looking to bring people across to the UK for certain activities. And that will be hopefully more straightforward going forward as well. The one thing you will need to consider there, though, is short-term business visitor agreements. An Appendix 4 short-term business visitor agreement, the tax and social security still needs to be properly considered. And I'm sure Chloe and Pooja would want me to mention about permanent establishment rules as well there. That's something you still need to look at as well, where people are, have you created a permanent establishment in other jurisdictions if people are moving about as well? That still remains as a risk and something to review as well as part of this area. Other than that, the budget, I think from my side, when I'm normally, knee deep in IR35 content, it was probably less detailed. I think the one thing to watch out for is a few consultations have been published as well around the digitalisation of pay as you earn and payroll and how that might work going forward, particularly looking at payrolling of benefits. So that's something myself and our payroll team will be looking at hybrid working and some of the rules around that, and also a consultation into the tax treatment of healthcare and wellbeing support. Will we see any changes there? Could PMI be tax-free? Unlikely, I would say, but they are looking at publishing a consultation into that, and I think those some of the things to watch out for in the future. So thank you very much, Chloe.
Brilliant, thank you, Ian, and thank you to all our speakers, who I might just ask to all come back on screen now, because I think we've covered an awful lot in the last 45 minutes. So maybe I could just ask you each in turn for one key takeaway that would be relevant for our listeners. So George, maybe I can ask you that question first.
Sorry, can you repeat the question? I sort of lost you there.
Sorry, George. I just thought if we could just all summarise one key takeaway for the listeners, given how much we've just talked about.
My key takeaway from this whole thing is that this is a very volatile environment. Forecasts are very difficult, so anything goes. But people need to be adaptive, and they need to be able to change their planning as the data changes, and it will.
Brilliant. Thank you, George. Nick, what about you, if it's possible to just give one key takeaway?
Yeah, well, I'll go straight off the back of George's changes in planning. I think there will be very few people now potentially that shouldn't be changing their pension planning, and just sort of sitting here, probably the only people that this won't impact is those over 75 without any business interest. Anybody else, I think, needs to be thinking about how they interact their personal tax and financial planning with pensions again.
Brilliant. Thank you, Nick. Pooja, same question to you.
For me, it's probably, while there's uncertainty in the UK and global markets, it's probably worth maximising any opportunities coming out of this budget sooner rather than later, in case anything changes.
Brilliant, thank you. And Ian, again to you, if that's okay.
I think just echoing what George, it's still a volatile and unpredictable time, and it's really important as an employer that you do focus on how you can manage your compliance, but also structure your reward as attractively as possible to attract the best talent. And some of that will be thinking a bit differently to perhaps how we were pre-COVID, or perhaps how perhaps we have over the last year, to think actually these are some of the things that people are looking for, and we can implement them to get them to come and work for us or to stay with us.
Brilliant, thank you all. And we've got a few minutes for a few questions that have come in, some of which I think we've answered on the question and answers as we go through. But Pooja, maybe I could start with you, if that's okay. There's the question around whether SMEs feel that SME businesses have been shortchanged in the budget. I know actually it was a similar question before around the R&D and the changes that were being talked about, implemented there. But what's your thoughts in relation to that?
No, thanks. And that's a good question, a relevant question. I go back to sort of, it depends on profitability, because the company may still benefit from a lower rate of tax. But if it's obviously a profitable SME and subject to the 25% rate of tax and not expected to spend more than £1 million on capex a year, which would be what would offset the tax rise for them, then yes, it is going to be a squeeze for SME businesses. I've seen a lot of it discussed in the press in the last few days. And what I'd recommend is having a look at whether, having a look at websites. So that's the government website, local authorities and business chambers are particularly helpful for any government grants that might be available for the type of activity that company is involved in. Because I think that's sometimes overlooked or not considered. And I'd also probably recommend having a proactive conversation with your usual tax contact and just explore any initiatives that could be relevant to your business.
Brilliant, and a great point there, Pooja, actually, about government grants. We think of R&D tax credits as being a tax refund, but actually in some way are no different to other government grants. So thank you for that. Ian, one actually come in, which is always one of your hot topics alongside IR35 and salary sacrifice. We haven't touched on anything today around national minimum wage. Is there anything that our listeners should be aware of in relation to that?
Yeah, definitely. The national minimum wage will be increasing again from April. So there's new rates published. £10.42 is the magic number for 23 and over there per hour. So be mindful of that. The other thing to mention here is HMRC are really looking at their teams. So they're committing a lot more resource to national minimum wage compliance. It's something that really needs to be looked at in a lot more detail now, alongside IR35, because that's where HMRC are putting a lot of their attention and detail. So I would say if you pay people even £25,000 or less, or you've got salary sacrifice arrangements in place, it's very much worth having a look at your national minimum wage compliance, because there's lots of things under the surface that will interact with it, be it uniform, be it working time, be it security bag checks after the work's finished. So we'd be really mindful of that, and definitely something that organisations need to take seriously across all sectors.
Brilliant, thank you, Ian. And just one more question, actually, Nick, this is for you, that's just come in the Q&A, but assuming the Labour reverses the LTA on pensions, is it possible to crystallise any savings before then, or will they be unwound with the reversal?
I think it's a really good question, Chloe, and I guess the ultimate answer is we don't know. The whole concept of crystallisation of pension benefits is naturally changed by these proposed changes. I think this is something that we're going to sort of spend a lot of time thinking about over the next couple of weeks as we move into the next tax year. On one side, you would think that if Labour did move to reverse the changes, they would provide the sort of protections that governments have done previously when they've put in sort of new limits. So we've seen various lifetime allowance protections offered over the years, and you would hope that a U-turn would come with that. On the other side of the coin, you could envisage that Labour might not want to sort of put in place protections for people who've just sort of broken one set of rules, or maybe not broken the rules, but sort of taken advantage of a short-term change in the rules. So as I say, there's no certainty over that at the moment, but it's something we're going to be giving a fair amount of thought to over the next few weeks.
That's brilliant. Thank you for that, Nick. George, a question for you actually around UK interest rates and how we think that might be affected. Any thoughts on that? You're on mute, George.
So UK interest rates, I think the budget, look, all other things being equal, if nothing changes from where we are, and the pro-growth budget succeeds in being pro-growth, then all other things being equal, it should move interest rates just a wee bit higher. Having said that, what we're discussing is that the all other things being equal is not the world we live in. We live in a world that's constantly in flux, and in a lot of it in a very volatile fashion. So issues that are going to possibly affect UK interest rates are going to be US interest rates, and they're going to be European interest rates, and it's going to be the stresses in the global financial system. And I think that latter has always been sort of a case for us that some sort of financial accident could help bring interest rates down quicker. You know, we were always wondering whether the system was resilient enough to take those interest rate hikes. And for those who follow our writings, we were sort of surprised in the beginning of the year that something hadn't already been broken. To be fair, I should put my foot in my mouth on this one, because I said, well, we're near the end of interest rate hikes. What can possibly go wrong now? Okay, so I need to revisit that. So it's going to be all of these things. It's not going to be the budget itself is probably one of the smaller contributors to the interest rate environment. But do expect interest rates to peak somewhere around here, maybe even 1% higher. But you know, if it was more than 1% higher, given what I know today, I'd be surprised.
Okay, brilliant. Thank you for that insight, George. I may just ask one more question, actually, if that's okay. And it's probably a mix of Ian and Nick, but I know it comes up in lots of conversations, and it's really, can you just summarise around those cliff edge points where the rates change substantially, and what our listeners really need to be aware of those key things? So maybe Ian, I could start with you on that and then pass over to Nick.
Yeah, I mean, there's a few cliff edges. You know, you've got the 50 to 60k when you've got the higher income child benefit charge, which gets removed, so that support goes at that level between 50 and 60k. But the one that's been, I think, coming to more focus after the budget is the 100k piece. I'll leave Nick to talk through some of that, but the fact that at 100k you'll lose that free childcare that was announced by Jeremy Hunt and the one for 3 and 4 year old if you earn basically a penny over 100k, really. So you've got to really look at that, and you've got to think about the fact that you've got the personal allowance changes as well at that level where it gets tapered back down to 0. So I don't know, Nick, I'll pass over to you there.
Thanks, Ian. Yeah, I mean, it is definitely a cliff edge. There's been some of the corners of social media over the last couple of days. There's been some analysis on this. Essentially, there's lots of things at play. There's the classic personal allowance trap, which most will be aware of. You effectively get taxed at sort of up to 62% on income that sits between the 100 and the 125,000 level, which doesn't sort of leave much net income in your pocket if you're earning at that level. You've then now got the 45% tax rate that exists immediately after that nasty sort of 62% tax rate. And then you've got childcare, which has been around for a while. The key thing that's changed this last few days is that will broaden to younger children gradually over time. So whereas most people would typically, unless you had twins or triplets or so forth, you probably only have one child that falls into that realm of free childcare hours. Now families could conceivably have 2 or 3 children, and naturally earning over 100,000 knocks all of those children down from 30 hours free childcare to 15 hours. And from somebody that's got a child in nursery, I can tell you that's not a cheap planning mistake to make. So I think there's going to be a lot more focus from people of that young family age at keeping their income very solidly below that 100,000 level, and naturally combining that with the pension changes and some salary sacrifice options that employers may be able to offer. There'll definitely be scope for some good planning around that, I think, over the coming years.
That's brilliant. Thank you for that. And I feel that's probably an opportune time to start to close this, because I'm conscious of time. But thank you all very much for joining today. I know we've touched on an awful lot, but if there is anything that you want to know about in more detail, then please do feel to reach out to any of us on this webinar today, or indeed your usual contact at Mazars. I'll just mention as well that you might be interested in joining our next webinar on the economy and investments, which is taking place on Wednesday, the 29th of March at 10 o'clock. The webinar will feature George, who has been talking today, alongside David Baker, our Chief Investment Officer and Head of Investments in the UK, where global economy, inflation, interest rates and the investment landscape will be discussed in more detail. But other than that, thank you very much. Oh, there was a quick question actually about what will be circulated afterwards, so that just to clarify on that, everyone who joined on Zoom today, we will send a recording of this webinar out. But thank you all, have a lovely day and have a lovely weekend.